400,000 Brits face a very large payment increase over the next 2 years.
A lot of clients just don't like the idea of paying £1,000 product fee every 2 years, because normally people add it on and it's just there's extra compound interest on that as well. If you are looking to sort of get your mortgage paid off quicker and you do have the sort of surplus funds to do it, the amount of interest you will save by either just reducing your mortgage term or making those overpayments because it comes directly off the capital can be absolutely huge.
Going into this kind of summer holiday, perhaps maybe it's the poor weather that means that they're not going away quite so much, but the market's quite active, and I think in terms of transactions, mortgage advisors are predicted to be a lot busier in the second half of this year than we were in the first.
I remember Obama saying when he made big decisions, someone asked him, like, how do you make those critical world-changing decisions? And he's like, I have to be 51% sure. Welcome to the Investors Corner podcast. This week, I've got Ves and Tom joining me, who are the co-founders of Mortgage Tribe. Clues in the name, both mortgage advisors. Ves, how are you, first and foremost?
I'm good. I'm really good.
Didn't know you were doing this podcast until about 20 minutes ago.
No. And I also didn't have a horse in last night's race. So I'm feeling very good today. Nothing won, nothing lost.
You did until yesterday, it seemed.
Yeah, well,
we're talking sweepstakes for the Euros final, right? Yeah. So this is obviously going out on Friday. I reckon everyone will have just about recovered by then. Not everyone. Some people that were out there probably not financially, but we can't give drastic financial advice on this podcast. But I'm sure we're going to cover some. And putting a deposit down on an England ticket in the final is probably not the best advice that you could ever give.
No.
Yeah, who knows? Although I did hear this morning that something like an additional 250 million quid's worth of pints were sold over the course of the tournament. So that's pretty good for the economy, I guess.
Positive, yeah. How are you, Tom?
Very well, Ian. I think last time I was on here, we had just got our FCA approval, which was probably about 6-7 weeks ago. But it feels like a lot has happened in that 7 weeks, which is all very exciting stuff. So yeah, we're good. We're busy and we're enjoying now that Mortgage Tribe is properly up and running, and we're really enjoying it.
Yeah, well, I mean, I've been loving the marketing, I've been loving the videos. You guys are giving a lot of great advice on your socials as well. So if anyone's watching or listening, they haven't checked out Mortgage Tribe, have a little look on Facebook, Instagram. You'll see loads of really good stuff, or the guys' LinkedIn profiles, which we'll put in the show notes as well. There has been a lot that's changed in the last 6 weeks. Obviously, Labour getting into government, we covered quite a lot of that on last week's episode, me, Mike and Andy. But one of the things that we probably saw from a trend point of view happen a week, 2 weeks prior to Labour getting in was marginal drops in rates, whereas I'd say most of this year we've probably seen marginal increases in rates. And when you just see a marginal thing, I think you told me I could save a £5 on mine the other day.
I thought I'd give you the notice, yeah.
But saving a £5 versus losing a £5 is a £10 swing. It's not huge, but it's significant when you look at the way it was going and the way now it's going. And we had this phrase actually on this podcast, which we were talking about probably about 18 months ago, when rates were so cheap and prices were climbing. Today is the cheapest day to buy a house. And we were right pretty much every time we put that phrase in 18 months ago. And then we stopped it because obviously interest rates had gone up. Prices were dropping a little bit here and there. Nothing drastic, but dropping a little bit. But my feelings tell me that maybe rates have topped. And you can't forecast what's going to happen. No, I can't ask you for advice today, but what's your gut saying on that from a Tom point of view?
I'd agree with that. We get an email usually 48 hours before a lender is going to reduce their rate. They always give us a bit of a heads up just to say if you put an application in too early, or if a rate is going to go up significantly, we need to get it in ASAP. It just seems like it almost seems psychologically the day after the election we're just getting there's so many more emails from lenders saying we're reducing rates by quite a small margin, but still it's better than no margin. So sometimes they're literally saying, I think Santander emailed us saying, 0.05% or whatever, but it's still going in the right direction.
Down, not up.
Exactly.
Yeah.
And I mean, whereas the actual bottom line might not have changed too much in terms of what is the lowest rate out there, that changes week to week, lender to lender, but it just feels like more lenders are going in the right direction. So if your situation, for example, is that you can't go for that lowest interest rate with Barclays, whoever, you've got to go to Santander. It just seems like that gap is now coming down a little bit, and it's a bit more competitive, especially with 2-year money. I don't know if that's because swap rates have come down. I think they have for 2 years rather than 5. The gap between 2 and 5 years seems smaller now than it has been for probably about a year.
Yeah, that's noticeable.
Yeah, whereas it has just been 5 years. 5-year fixed rate has been so much lower than 2 years. So I think it's giving people much more of a question to sort of ask themselves now, how long they want to fix for, because people were just going for 5 years just because it's the lowest rate.
Yeah.
I think I'd agree with what you said.
It's the big challenge, right, Ves, is at the moment when your gut's telling you that, I think the base rate review is the 1st of August and rates are marginally dropping, and you're due a remortgage or you're looking to buy, and you see the big difference on the 5 and the 2, it's just an easy sink to just go 5. But now, 3 months later, if you look at that 3 months ago, very different to now, because you're thinking, if I lock in for 5, I've got big penalty fees, and rates could be massively different in a year time. Mm-hmm. And do I actually want to bite the bullet, do the 2-year fixed, and then actually reap the rewards of that gamble, if you like? It's really difficult for people out there, isn't it? And everyone's individual, I appreciate, but that must be a conversation you're having with a lot of clients at the moment.
Yeah, and it's I had an example recently where we actually just sat down and said, look, let's just work out what it would cost you if you went for a 2-year fixed. What additional fees you might incur in 2 years' time for remortgaging, how much you think you might, because there's no point in me speculating how much I think the rate's going to go up or down. But this particular client turned around and said, well, what if it was at 3.5%? So I said, well, let's just work it out. Work it out how much it's going to cost you to remortgage, potentially another product fee, how much you're going to save over that second stint of 3 years. And I think the difference at the time wasn't huge at the time we were looking at this, and I think that just sort of putting it down on paper in front of them on a Teams call together, it just helped them sort of decide, we'll swing for one as opposed to the other. And I had a very different case where actually I think sort of as part of the advice process, you figure out what's affordable for the client, and you can give that advice, and the client always has a slightly different tolerance to risk. Mm-hmm. So you can kind of get a feel as to which way they're going to go for, the 2 or the 5. But having said that, sometimes it's a case of just having another voice from the industry say to you, well, both are affordable. And actually, as soon as they hear both are affordable, their sort of tolerance to that risk can change a little bit, if that makes sense. I mean, we're not going to recommend a 2-year if actually a 5-year is what's needed in that particular situation. And in certain cases, you might need to go for a 5-year because that's what's allowing the lender to use a different set of stress testing.
They'll lend you more sometimes on 5
interest rates. Yeah, so sometimes on 5 you get a more favourable stress test rate, and actually that can be a make or break of a particular application. So there's a lot of things that we can kind of discuss and briefly touch on, but actually it's kind of on a really individual basis. I remember we spoke about this in your we did a seminar or a podcast or something along those lines, I remember recently, and we discussed
Given
that.
the same sort of,
the online, And actually it's really individual. There's no right or wrong answer. It's just...
Well, it's interesting because, Ian, you're in the exact same position yourself, aren't you? Because your mortgage is due at the end of this month, and you initially were very much, you wanted to go down the 5-year fixed route. But now that the gap is sort of closing a little bit. We were sort of having a discussion the other week as, when's the latest can we sort of make that decision, which is normally about, I'd say 10 days before. And the question I sort of asked to people is, what's more your priority? Like Ves said, your attitude to risk. But if you were to go for the 5-year fixed rate, say in year 3 rates start to come down, how much, how
much do they need to come down to be worth it?
Yeah,
basically?
I think also the bit that probably people don't often think about that has caught me over the weekends, because I was talking to my wife about it and said, right, obviously we're about to see quite a drastic increase on the mortgage, and I saw there's a BBC report on the 13th of July, if anyone wants to check it out. It had a whole bit, but it highlighted at the end that 400,000 Brits face a very large payment increase over the next 2 years. That was the substance of the article, effectively, as you've got in this case, nearly 500,000 Brits over the next 2 years that are going to go from these 1 point somethings into these 4 point somethings, which I sit in that bracket. But the bit that I was then looking at was, my plan is, with my 5-year scenario, even though it's going to drastically hike up, is still to start doing overpayments, because I'm 40 now and I'm looking at that, and it's not something I've been looking at previously, because I was in my 30s, I wanted to buy this, that and the other, but now I'm looking at it thinking, well, I need to get this bloody mortgage down, and I want to get it down earlier than when the end rate is due to kick in, or when it's finally paid off. So I'm now looking at it thinking, well, if I went 2-year, it would probably almost be unaffordable to repay any of it. And then the gamble is, in 3 years' time, I might be able to then overpay more, or I might not be. So now I also think that the third mechanism to throw in when we're having this discussion is, what's a 2-year fix like? What's the 5-year fix like? What's the gap? And actually, how does that benefit you if that gap is an overpayment on the 5-year fixed? Because that might actually be more beneficial than even if we did see a 3.5% rate. So it's really hard for you guys, because there's a lot of,
it is, and like I said, it's
a lot of if, buts and maybes.
Yeah, and it's like, said personal preference. And I remember you saying, I think Mike said this as well, like, a lot of clients just don't like the idea of paying £1,000 product fee every 2 years, because normally people add it on, and it's just, that's, there's extra compound interest on that as well. But if you are sort of looking to sort of get your mortgage paid off quicker, and you do have the sort of surplus funds to do it, if you sort of look over sort of a period of time in terms of almost like an investment, the amount of interest you will save by either just reducing your mortgage term or making those overpayments, because it comes directly off the capital, can be absolutely huge. Because, especially in the first, say, if you're on a 25-year mortgage, it always seems like in the first 10 years you're mainly paying more interest. And then towards the end you sort of start to see the capital come off better. So, yeah, I think what you're asking there, Ian, is what a lot of people will be sort of trying to weigh up themselves.
So we covered kind of, have they bottomed out, and we all feel maybe with
hopefully,
I remember Obama saying, when he made big decisions, someone asked him, like, how do you make those like critical world changing decisions? And he's like, I have to be 51% sure. That's always stuck with me, because it's like, when you're making a big, if I'm 51% sure that I'm making the right decision, that's what I'm going to go with. So I think we'd all say we're 51% sure that they've bottomed out. Is that fair?
Yeah,
I'll give 52.
I don't know if my my baseline for decision making would be quite so low.
If it's good for
if it's good for Obama, it's good enough for us.
I'm going to take it. Yeah, I'm not sure whether Biden and Trump live by those rules, but let's not get onto US politics.
It's a different world.
Yeah, but one thing that I did see is that Labour, actually quite interesting, their biggest gains for voters were mortgage owners, and a lot of people that are cash only equity were voting for the smaller parties. So it was quite interesting to see how dominant Labour were in the election. It was quite interesting to see the swing with a lot of people as well. Typically speaking, if you've got a home in the UK, you're going Conservative, typically speaking, unless you're a bit lefty. But this time round, it seemed like actually the confidence was in the manifesto that Labour put forward. I don't know whether you guys have managed to drastically look through that, or in-depthly look through that, I should say. But a lot of it is housing policy related, trying to get vacant properties regulated so that they're getting those moved on in some fashion or another. But again, the word confidence is used. If we do see a base rate drop on the 1st of August, it feels like everyone's kind of like, okay, Labour are in, let's just sort of crack on. So
I don't know, I had a conversation with a Labour candidate, because she was the only one that called. None of the other ones called, and I had some questions regarding the property market. And I must admit, I wasn't completely sold on the solutions that they put forward, and there was things that I felt perhaps weren't as well thought out as you'd probably want them to be if you're looking to form a new government. But I think just looking at the alternatives, for a lot of people that perhaps weren't willing to consider Conservatives a second or a third time based off results and performance from previous elections and governments, a lot of people would have looked at the other available options and either gone for the smaller parties, which might not have been able to be given an opportunity to cash any of the promises that they were actually making in those campaigns, the only ones that could really be held to account were Labour in terms of having a majority government. So I think it was almost like a lack of choice, I think, for a lot of people. But having said that, and I think Tom kind of touched on this a bit earlier, it has been kind of a feel-good factor in the mortgage market for a few weeks now of things shifting in the right direction. I don't know if Labour can take credit for all of that, but I think there is a bit of a feel-good factor feeling that is affecting the market, and people are going into this kind of summer holiday. Perhaps maybe it's, the poor weather that means that they're not going away quite so much, but the market's quite active. And I think in terms of transactions, mortgage advisors are predicted to be a lot busier in the second half of this year than we were in the first.
I think it doesn't surprise me too much, the people with mortgages sort of voting for Labour, because I think people who may have voted Conservative all their life, for example, or majority of their life, there's certain things that's happened in that party with, how you can, and it gets very political, but, how they handle COVID, and you got all the party stuff and the scandals. But I think the minute that doesn't actually affect the man on the street. The minute, what was it, when Liz Truss sort of announced that budget, all of a sudden that affects everyone on the street, and they're just like, I want something different. I think that was the sort of the final straw for a lot of people, and it's like it's now time to just vote for change rather than Labour, and I think it just feels like a bit of a fresh start, and hopefully just a bit of a bit more sort of calm in the market, really. But
as this is an investors podcast, and there's a lot of landlords listening, a lot of people that want to be landlords in the future as well, that are trying to sort of take tips and advice. What do we think, with the way the mortgage world sits at the moment, it all means for the landlords, for the investors? Because there's been a lot of talk about, the drastic exit rate of landlords, and typically there has been an exit rate for landlords, but it's been outweighed by the purchasing of new properties. But we're not seeing that at the moment. The pendulum shifted the other way. Have you had many conversations since the business launched with property investors, or is that still pretty kind of bleak at the moment?
We have, and I say, we've had a few sort of buy-sells, and a lot of people just want to, it seems to me now, a lot more people want to look down the limited company route. And it's still weird. The buy-to-let rates, the lowest sort of rates, are still lower than the residential ones, which I've discussed on this podcast a few times. But I think a lot of that is because they needed to really make up the lost business from 2022 and 2023. But I think there's still an appetite, because people know that property is a good investment. People want to get into it. It's just, can I make the numbers work, and how's the best way of doing it? And I think people are just asking that one more sort of question now, as to sort of, I know I want to do this, but just what is the best way of doing it? Which obviously everyone wants to know, but I think people are just a little bit more cautious about it. And like I said, the limited company sort of route and, the inquiries for that seem to be more than I've probably ever had, to be honest with you. But I don't know what you sort of think on that, Ves.
Yeah, I think you certainly have to sharpen the pencil when you're looking at your business plan, that's for sure. Some interesting things that I learned from a lenders conference that I went to, or a mortgage advisors conference where a lot of lenders were there, is they shared some statistics with us, and a lot, in fact, I might have some of them here with me actually, in my notebook. But one of the things that they talked about was how, yes, landlords are exiting, but ones that currently don't have, they're sat on properties owned in cash, right? No mortgages.
Yeah.
Those are the ones that are at a fastest rate refinancing to grow their portfolios. And I think landlords are making a decision of, if I'm kind of on the fringe of this and I'm not doing it seriously, I'm not going to get a return here. So I think people are making a decision, either double down or get out. And I think that decision has been probably what's getting people moving, either out of the market or into the market. And I think where there's probably some quite good deals to be had on properties, on leasehold properties at the moment. I mean, you'll share that information with us. I just feel like there's probably opportunities for those landlords that are serious about it and are willing to go down the limited company route to make that work from a numbers perspective and a mortgage perspective. And mortgage lenders are becoming very creative in terms of how they help landlords do that, whether it be kind of a controversial booking fee, or whether it be offering some slightly more flexible products that we haven't really seen in the market. There's appetite from the lenders to help those people that do want to stay. And the people that want to go, there's probably not much convincing that you can do. I think some people would have just decided, I'm out. Like, this is just too much. I've already got a full-time job, got a family. This is just too much hassle for me to run. Throw in a bad tenancy here and there, and I think people are, okay, I'm done.
I think also we're quite an ageing population, and I think because people are living longer, and the way the whole kind of the baby bloomer kind of bubble, you know, was, it now also means, and the data's out there for everyone to see, but there's more people in their mid to late 60s than there ever's been on record, and a lot of those people are those baby bloomers that have had those buy-to-lets, and they're now going, actually, I'm ready to exit and cash in on my asset and live the rest of my life in an enjoyable way.
Yeah.
Or, like you said there, Ves, is they've got no finance on it, and they're looking at actually saying, well, maybe I could finance half of this.
So it's 38%. So can't remember whether it was who it was of the lenders that was on the panel at this seminar. Came out with the figure that's 38% of landlords currently have no debt on their portfolio whatsoever. It's quite a large number.
High,
38 is nearly 40.
High. Yeah, that's
and if you're sat there and you're thinking, all right, how much can I raise out of this portfolio, and how much can I grow that, because there's some good deals to be had out there on leasehold property, there's probably a lot of people that are the opposite end of the spectrum to the one saying, I can't be bothered with this anymore, I'm out. Opposite end of the spectrum, where they're sat thinking, I could turn this into something more than what it is now with very little effort. And I think, Tom, from a Mortgage Tribe perspective, the buy-to-let business goes via Tom, so I think you can comment on that. But I think you just mentioned yourself that you're having a lot more inquiries. So
yeah, well, like you said, and also the lenders are a bit more creative, because at the end of the day, remember, they do want to lend. They're not they don't make any money if they don't lend. So, you know, there's a couple of lenders out there who are sort of the almost go-tos for limited company, and because they know that the taxation rate is lower, that sort of thing, they will potentially lend a bit more. They might make you do it on a 5-year fix rather than a 2-year fix, which is what I'm finding with probably the last sort of 4 or 5 buy-to-lets I've done. They've had to go down the 5-year route because that's just how the lenders do their stress testing. But yeah, the lenders are, you know, they want to sort of get creative and help landlords, you know, increase their portfolios or create first-time landlords, because it helps them at the end of the day to sort of be having more customers on their books. So,
and the stats show for the property market, for purchasing in general, that we're up on where we were last year. We're up on 2019, 2018. So the property market is not actually in a bad place. It's pretty stable. You know, whether you look at one report or another, the last 12 months has either gone up 1% or dropped 1%.
It's resilient, isn't it?
It really is. You know, and I think what will be quite interesting as well is at the point of this podcast dropping on the Friday, which, you know, we're only a couple of days from as we talk today, but all kids will be pretty much broken up from school. And the summer slump is a real thing, you know, in the agency world. You know, we're going to hit end of July and August, and there will be less people buying homes. So you look at that in two ways. If you're the banks, you will be writing less business in summer to when you get to September and October. So normally from a business point of view, if you're preparing for that quieter period, you've got a plan to try and make sure you see the rewards in the busier period, which is September and October, or you're naive to it and then you get shocked and have to knee-jerk in the busier periods, which I'm sure the banks are not going to do that. But it does strike me as a little bit of positive impact going on here. Maybe the 1st of August we see the base rate drop, and people are just getting themselves ready for that real hectic part of the year, which is September and October. Because as estate agents, we have to just accept that there will be less buyers. It doesn't mean you have to do less deals, but there'll be less buyers. So flipping it back to an investor's perspective, I would say if you're looking to get a really good deal, August, December, 2 peak months to go and get good deals. Because if you've got a seller that's found their dream home
and they want to sell quickly,
and you're the only buyer out there with no chain.
Yeah, I mean, we sold my partner's flat in August last year. So yeah, that's when we put that deal together. So I think stuff still goes, for sure. And I think if you're an investor looking into the property market, you're sort of trying to go against the grain a little bit, aren't you?
Absolutely.
You try to sort of keep out of people's way in the really busy periods, and then take advantage of the times where everybody's off on holiday and still a bit lethargic from Christmas. So stuff like that. I think that's really great advice. But from our perspective, it's just nice that a lot of the time, to go back to that original point, we're not going back to people and saying you're going to save loads of money because Halifax have just dropped their rates. You're saving 30 quid. But we're part of quite a few mortgage advisor forums. And actually one of the posts last week was just about a guy kind of sharing a screenshot, no obviously personal data, but sharing a screenshot of like, I've got 4 mortgages who I need to just call now and just tell them that their rates just come down. So he was like, happy conversations, it's better than turning around and saying, unfortunately, the rate you've got is being pulled. So sorry. So it's just, a bit more positivity. And I think that kind of adds to the feel good factor. So it's lenders are open for business. And that conference that I went to, about 75% of the lenders there were there to talk about buy to let.
Yeah,
I thought it was a bit disappointing actually, because I was there really like thinking, okay, I'm going to get my sort of teeth stuck into some complex criteria with resi and stuff like that. But no, 75% was buy to let.
Well, we know what's happened with supply and demand on the rentals, and that's been a huge part of it, because with the exit rate that we're seeing with landlords, with how difficult it is now to buy a property as well, with the 3% stamp duty, etc. And the tenant demand has just gone mental over the last 3 years. So prices have just, you can add 10% to a rental, price for the last 3 years in a row. That's had a huge impact. And the question I'd ask you guys is, if you had 100 grand, what would you invest?
I've answered this question on a previous podcast. I actually messed my maths up when I did it, so I made it right for
myself. But not necessarily just property. Is there anything else that you would look at the moment? I've made a conscious decision over the last couple of years to try and put more eggs in more baskets, shall we say, learn a little bit more about more things and try and understand the stock market a little bit more and other different things as well. So I guess the question for you guys as mortgage advisors, but more talking as Ves and as Tom, and I'm very sure that this will be very different between the two of you. So it's a question I'm interested to know for people that are in property, that are in finance. If you've got 100 grand sat there to invest and you have to invest it tomorrow.
I'll go first.
I think I know what Ves will say, but
I think you both know what I'll say. Is that I think if I've got 100 grand's a lot of money, and I'm not a financial advisor, I wouldn't know how to optimize that purely from a tax perspective. I wouldn't know where to start. So my first point of call would be a financial advisor. And I thought you
were going to say watches, actually. But
yeah, I don't know. Maybe we do that before speaking to the financial advisor. But yeah, no, I think I just don't trust myself with making the right decision for that amount of money. So I'd just rather put that liability on someone else, somebody who's preferably got some accreditations and experience and some kind of fallback on if things weren't to go right.
And if there was no financial advisors available to take that call and you had to spend it today, where would your gut say?
Oh God, you're really
you said you wanted to go first.
Yeah, no, I still think I wouldn't know where to start, honestly, because the thing is, most of my time on a day-to-day basis is spent looking at mortgages and doing mortgage applications and obtaining mortgages.
We're helping people spend their money, but
so in that respect, I think I wouldn't know where to start, just because I don't spend enough time doing it in that respect. Okay, if we rewind, this is interesting. Rewind to when I first met you 15 years ago, and I was a young estate agent. The thing then was to aspire was to just get a buy to let. Do some really good sales months, sell as many houses as you can, or in my field was book as many valuations as you can. Make some good commission, get yourself a buy to let. Plan for retirement. Even though you were that young at that time, that was just the kind of atmosphere that you were in. People were buying houses. Now I just wouldn't know where to begin with that. I think in my head it's a difficult decision.
I've quite a boring answer to it, but it's only because I was watching a video by Scott Galloway. I don't know if you know him. He's a really interesting American guy, and I think he spends a lot of time in London, but he was talking about the power of compound interest. And just if you can someone gave me 100 grand now and I didn't need it for 15 years. He shows the power of stick that in a bank and let it build up and build up and build up and just see what it will do. Every bit of interest you get, you put it back. And again, I'm not good enough in the maths on how that kind of thing works, but he's just showing the power of it, and just if you can afford to leave it and do nothing, and but over a long period of time in quite a high risk investment, because it always goes up and down. But it's like pensions really. my pension advisor who says go for the high risk stuff because you don't need this for another 25, 30, whatever years. It will most likely go up rather than go down. So it depends what your goal is. Do you need something short term or long term? But if you don't need anything in a particularly short term, I can't remember what it's called. It's something to do with compound interest. But his name's Scott Galloway. He's a really interesting professor in America, and he talks about a lot of stuff. But a lot of it is financial stuff. It's really interesting.
Well, I think
they say it's the eighth wonder of the world, isn't it? Compound interest.
Yeah.
So.
And I think that the gold here for anyone that's looking at it, really, when someone says, doing a lot of research into it myself, when someone says compound interest, all I hear is patience.
Yeah.
And that's the biggest mistake that most investors will make, is they are impatient. Mm-hmm. And whether it's a stock market, whether it's a savings account, whether it's a buy-to-let, whether it's whatever it is, they see a little squeeze, or they see a magpie effect somewhere else, or a friend down the pub, or someone else has just put money into this, and they just get impatient. But with a high interest savings account, what that diagram looks like to visualize for people that are listening or watching is basically the opposite of what you see if you overpay on your mortgage.
Yeah.
Because the compound interest of repaying your mortgage makes it do that, and then it goes, and then it's quickly paid off at the end. So it brings obviously the payment date forward, if you like. It's the same when you flip it onto a savings account. In reality, it doesn't really do much for a while, and then all of a sudden the 500 quid that you've been putting in has been compound interest on the 4.1% Monzo account that you've got, or whatever it may be, and in 15 years time it's all right, but in 5 years time it's like meh.
Yeah.
And in 25 years is pretty nice, and in 30 times it's bloody amazing.
Yeah. But you need to sort of show, almost dangle that character. This is what it will be in 20 years, but you're going to need to wait that long. It's not going to be a 5-year sort of investment.
And the magic moment and the magic time to do it is when you're like 18, 19, 20, 21 and just forget about it.
Yeah.
But what 21-year-old goes, I got $5,000 in a bank account and I'm forgetting about it.
Yeah.
It just doesn't happen. And that's the trap that obviously we sit in. I've got ISAs for both of my girls, and just the other week my eldest turned 8, and she's had money going into that account since she was born. She got a healthy sum in there.
Yeah.
And if she wasn't allowed to touch that until she was 30, she'd be a very wealthy 30-year-old.
Yeah.
But the problem is she gets access to it when she's 18.
Well, I think kids these days need more education on finance than ever. And again, we've spoken about this before in here, but I think you, Ian, put a post up a few months ago, and it's quite frightening. It's about putting a pair of trainers on Klarna or something like that. And I think, again, go back to patience. A lot of people in this day and age, they want everything now. They say, well, I can't afford that pair of trainers, but I'll stick it on a Klarna thing. And we see it with mortgage applications time and time again.
Oh, but it's okay, Tom. It's 0% interest.
Yeah, 0%. So that doesn't. We get that all the time. Have you got anything on credit card? About $6,000, but it's on 0%. I was like, oh, okay, we'll just forget about that then.
But you learn that, don't you? You learn it in different phases.
That's where the education comes in.
In my late 20s, it was stature, it was buy things, keeping up with the Joneses, you use the finance, and people, it's the cheapest, the mortgage would be the cheapest money you ever get. So you're like, well, I'll pull 30 grand out, I'll pull 20 grand. So, all of a sudden you end up with big mortgages, and then you go through your 30s and you're trying to kind of balance yourself out, but you're very high debt in your 30s because you've done all of this purchasing. And then for me, now I've hit 40, now all I'm looking at is, right, I don't want to look at my mortgage illustration, see what it sits at today, see what it's going to sit at the end, and accept that. Like, that's not acceptable for me to pay back over double what it sits at today over the next 21 years.
Yeah. I mean, I think this, in that respect, I think there's we're sort of going through quite an educational time period. And I think I've mentioned this on a previous podcast, that if you're really interested in finances, there's lots of information out there for you. And I think to an extent, it's a lot easier than 15 years ago when you'd be looking to get a buy-to-let, but you'd need to go and speak to someone, you need to go and get some advice from this place and that place and collate it all together. Now information seems to be a lot more consolidated, so there's
a lot of good and bad advice.
There is some terrible advice. Like spending $100,000 on watches is probably terrible advice. Doesn't stop me from doing it, but no. But the point is, it's accessible and it's there for people. And I think, especially from a buy-to-let perspective, if you're going to be serious about it, just sit down with the relevant individual, whether that be a mortgage advisor who's going to help you figure out how much it's going to cost to finance those, or whether before you speak to a mortgage advisor, you speak to a financial advisor to figure out whether that is actually what you want to do. Because I think a lot of the time, if you're you're going to get yourself into property investment, you've got to know A, what you're getting yourself into, but B, figure out if you're in it for the long run, because I think at that point rates are high, those returns are probably not going to be great short term, but actually you might figure out in the long term that it's still worthwhile doing, especially if you can get yourself a portfolio going.
Yeah, it's a great point, and the most difficult thing, we go back to that patience, but also, as I highlighted, 20s, 30s and 40s, your goals change. You know, like you could be really patient, you know, in your latter 20s with a goal, but it might be a different goal because you've had kids or jobs changed or whatever. And sometimes with your investments, like you say, getting the right advice is really key, but it's also remembering that investment, be it a property or stocks and shares or high interest savings account or a watch or, you know, a car or whatever it may be, you know, an antique car or something like that, whatever you've invested in, whiskey barrels, it comes down to remembering, right, this investment only works if I allow it to breathe until this time. So even if your goals change, that has to be forgotten. And where I think a lot of people that go wrong on their investments is they pull the plug on the investment too soon. And I think we're seeing exits with the buy-to-lets at the moment for people that have got to the point of retirement and gone, I'm going to cash in on my investment. And well done, like fair play to you. And what I think we now need to see is a lot of these limited business owners, these small businesses that have made really good money and profits over the last couple of years from furlough and things like that. They're the people, those new lifeblood of investors should come in now, because I feel if we have bottomed out on interest rates and if prices are now stable, it's only a couple of years until we see another boom. And we don't know what will catalyst throw that off. Something will happen, and it could be the fact that there are not really any help to buy schemes, first time buyer schemes with new builds. Throw one of those in and stamp duty holiday, and we see, you know, a 2% drop in the base rate or 1.5% drop in the base rate. If that all happens in the same year, which could quite possibly happen next year with a new government in play, bang, the market goes bonkers, and you're either on the boat or you're off the boat.
Yeah.
So it's kind of, you've got to really set up, I think, what your plan is, your goals are, and what excess money you've got. You mentioned do things that you can afford, get good advice. And it'd be interesting to speak to you guys in another 7 or 8 weeks and say, right, how's the summer slump been as we kind of hit those hectic months of September and October, and what have the rates done? So yeah, it's been very different since we spoke before, and I'm sure it'll be quite different again in 6-7 weeks time as well.
For sure.
Yeah, so if anyone wants to speak to Ves or Tom from Mortgage Tribe, some of the links are in the show notes. Check them out on socials, because there's loads of great advice on there as well. And as you can say, they live and breathe mortgages. Ves has got his mortgage notes book constantly with him, whether he's out on a date with his missus or not. So these guys live and breathe it. So if you want
Tom sleeps in his Mortgage Tribe t-shirt.
Yeah, I've never not seen Tom on brand since launch, which is, as I vouch for, is quite good. If you're watching on YouTube, you see we're all on brand today. So yeah, gents, thanks for coming on. Really appreciate it.
Thank you.